Hey everyone, this is Mason over at the Kendall Report. As most of you know, Bob is currently out of town, but before he left to go out of town, he finished his 9-part video course on his TradingView indicators. So if you already bought the TradingView indicators, there should be an email in your inbox. If you don't see that email and you want access to the video course, just simply send us an email at info@kendallreport.com and we'll send it over to you. So with that, I'm going to play a quick preview of one of the videos from the new course. And of course, if you're interested in buying the TradingView indicators, the links are down below in the description and the comments. You can just go to kendallreport.com/indicators and get everything there. Enjoy.
Let's apply all the PPMs so you can get the full view of them. Then we'll start to talk about the angle of attack, and then we'll go into breaking down the actual rules on a single PPM on one moving average. So we go to indicators, invite only scripts, and we're going to put them in order: PPM 1, PPM 2, PPM 3, and we'll put on Wavetech 200. So we have them all on here. PPMs to understand the trends and where the ultimate end of a trend is. So let's take off all of the indicators that are on here right now. I will leave PPM 1 on, so I'll take off all the others. So on the screen now I have a simple 10-period moving average, which is the red line on the chart above, and I have PPM 1. Now PPM 1 actually tells us all of the internals of the moving averages. In the indicator itself, there's 3 lines. The primary line is that angle of attack. The other 2 lines are actually the first and second derivative. Green line is the first derivative, blue line is second derivative. Before I get into showing you the exact rules, I will point out some of the key areas that I'm talking about here. On the indicator below, PPM 1, start to see some acceleration. During this time, you see the angle of this moving average start to move up. This is a daily chart that I've got up here. It tells you everything about when certain elements will happen. I will get into the exact rules in a minute, but I just want you to see that angle of attack. And ultimately, when we get all 3 moving averages, you'll see 3 angles of attack happening at the same time. Going to the theory that I talked to you about just a minute ago, that there are 3 phases within every trend. Now, I don't care if this is a 5-minute graph, a daily chart, monthly chart. It does not matter what the time series is. It is constant throughout the time series. So in this case, you can see that angle that is occurring. So let's talk a little bit more about the angle of attack. This graphic takes the basic concept behind the angle of attack. As I mentioned earlier, it's an aviation theory. As an airplane starts to climb too sharply, the wings lose lift and rolls over. Same thing, if you think about it, happens with markets. They go up too fast, they correct back. So this really came into play when we were looking at this theory. Basically put probabilities on every point along the lines of what the hierarchy was, or basically what the probability was for to stay above or below. So let's just go into a little bit more theory here. And as we look at this chart, you can see this angle of attack. Well, sometimes when it gets here, you'll see more of a parabolic move like this, and these numbers here, this is your whole integer. For the most part, a 0.25, which is being shown right here with this horizontal line, a 0.25 is where a trend level happens. When that happens, if you look down at the probability chart below, it's around 35 to 40%. As the higher the PPM goes, the lower the probability that the market will be able to penetrate. So we'll say this is the 10-period moving average that we're looking at right here. This will be our 10-period moving average. And once it starts to rise at a certain level, the possibilities of the market going through here become less and less as you go up, to the point where it's above around 0.1, 0.8 plus, it's less than 10%. Now, sometimes you'll see numbers on weekly charts that'll be 2 point or 5 handle, where it'll be 5.35. That just tells you that there's virtually no probability that the market will drop below that. Typically, when that happens, you'll see when these get to extremes like this, actual moving average that we're valuing is not really going to be in play, but the elements of the trend and the strength of the trend is, now these indicators, the PPMs, do not get overbought or oversold. They're not like a MACD or a relative strength. That's not how they work. And I'll be going through that as we get into theory here in a few minutes and actually bring up the PPM so we can start talking about those characteristics. But right now, the angle of attack, this is what it's about. So the PPMs are attached to the 10, 21, and 40. So as you'll see as we go through this presentation, PPM 1, 2, and 3, PPM 1 is tied to the 10 period moving average, PPM 2 is the 21 period moving average, and PPM 3 is the 40 period moving average. And we do use in certain circumstances the Wavetech 200, which is tied to the 200-day moving average. So these are all the basic concepts that are involved in understanding at least the angle of attack. Each one of these tell us what the probabilities are, whatever that moving average value is, the probability of the market declining below it if it's a downtrend. Otherwise, it would be the probability of rising above that. So let's get into the actual PPMs here.